This morning, something critical disappeared, and almost no one realized what it meant. There was no headline, no urgent alert, no warning crawl on financial television. Yet a single missing element quietly exposed a fracture in the system. The product pages were still live. The images were still pristine. The specifications still looked reassuring. But the one thing that actually matters was gone. The ability to buy. Not delayed, not marked unavailable, removed completely as if it had never existed. That absence is the story. Markets do not collapse with noise at first. They collapse with silence. They fail in small, deniable moments that can be brushed off as technical issues or temporary precautions, until suddenly they can't be brushed off anymore. What you are seeing right now is one of those moments, a point where confidence quietly steps aside because physical reality no longer cooperates. This is not a software problem. It is not caution. It is not responsible risk management. It is what happens when an institution that is supposed to anchor trust realizes it cannot deliver metal at a price that aligns with the narrative. When that happens, access is removed before questions are asked. And this is why you are here. Not for reassurance, not for comfort, but for early signals. The kind that appear long before prices move on a screen, long before headlines admit anything is wrong. By the time mainstream coverage explains this event, the opportunity to act will already be gone. When official sellers quietly shut the door, they are telling you something without saying it. Supply is no longer flexible. Replacement is no longer easy. And control is already slipping. This is the first crack, not the loud kind, the dangerous kind. Once that door closes, the mistake most people make is assuming it can simply be reopened. They tell themselves this is temporary, procedural, or precautionary. That assumption is how capital gets trapped. Because in real markets, especially physical markets, access is far more important than explanation, and when access is removed, the chain reaction has already begun. Here is the part that rarely gets discussed. Sovereign mints are not just sellers of metal, they are psychological anchors. They set the tone for what the market believes is normal. When they sell at modest premiums, the message is clear, supply is healthy, logistics are functioning, and the system is under control. That belief keeps pressure off the rest of the supply chain. It keeps private dealers calm. It keeps premiums contained. It keeps buyers patient. But when a sovereign mint steps back even silently, that anchor is ripped out of place. Suddenly, every participant downstream has to reassess risk in real time. Authorized purchasers lose their most reliable source of material. Private dealers are forced into the secondary market. Inventory that once flowed smoothly now becomes contested, and at the very bottom of that hierarchy sits the retail buyer competing for whatever physical metal is still available. This is where perception shifts. The price you see on a screen stops being a reference and starts being a suggestion. The real price becomes whatever someone is willing to pay to secure delivery. That gap between paper and physical does not appear overnight by accident. It appears when trust in replenishment breaks. And here is the critical insight. When one sovereign mint pauses, it creates stress. When multiple sovereign mints pause in close proximity, it creates contagion. Demand does not disappear, it migrates. Buyers pivot to the next available source. That surge overwhelms the next link in the chain, then the next. This is how localized strain becomes systemic pressure. Nothing about this process is emotional, it is mechanical. It is the predictable behavior of a tightly coupled system running with no slack. Once redundancy is gone, every disruption amplifies the next one. This is why what you are watching is not an isolated event. It is the early phase of a supply-driven repricing cycle that most people only recognize after it is already well underway. To understand why this phase is so dangerous, you need to understand hierarchy. Physical silver does not move randomly through the market. It flows through a structured chain, and stress always appears at the top before it explodes at the bottom. Sovereign mints sit at the highest level of that structure. They do not just distribute metal, they legitimize the system. As long as they are selling, the market believes there is always more supply somewhere upstream. Below them sit the authorized purchasers and large private dealers. These firms are not independent islands. They draw from the same refiners, the same logistics routes, the same inventory pools. When the top of the hierarchy goes dark, everyone below it immediately loses certainty. They can no longer assume replenishment. They have to compete for what already exists. That is when behavior changes. Dealers stop advertising availability. Premiums jump not because of greed, but because replacement risk explodes. Every ounce sold might be an ounce that cannot be replaced. In that environment, holding inventory becomes more valuable than moving volume. And once dealers start thinking defensively, liquidity dries up fast. At the bottom of the hierarchy are retail buyers. This is where the pressure becomes visible. Buyers who waited for confirmation suddenly realize there is no longer a trusted source. They are no longer choosing between brands or designs. They are choosing between acting now or being shut out entirely. That is when bidding replaces pricing. That is when premiums detach from logic and reflect urgency instead. This is the point where most people misread what they are seeing. They look at elevated premiums and assume the market is overheating. In reality, the market is revealing the cost of scarcity. Paper pricing assumes infinite flexibility. Physical markets punish that assumption brutally. And once this dynamic starts, it rarely reverses quickly. Because even if demand cools, slightly confidence does not return overnight. Buyers remember who shut the door. Dealers remember how hard replacement became. The system carries that trauma forward. This is why early signals matter. By the time the stress reaches the bottom of the hierarchy, the advantage has already shifted. Those who acted early are positioned. Those who waited are negotiating from weakness. At this stage, numbers begin to matter more than narratives. Because stories can be spun, but ratios cannot. When demand accelerates inside a system that was already running tight, the math exposes what explanations try to hide. And once you see the imbalance, it becomes impossible to unsee. Sovereign mints do not produce metal. They transform it. They depend entirely on a steady inflow of refined material from third-party suppliers. That means their ability to sell is constrained not by branding or demand, but by raw inventory and lead times. When incoming material cannot keep up with outgoing orders, the system hits a hard wall. Here's the critical point. Demand does not need to be extreme to break a fractional system. It only needs to exceed replacement capacity. When orders arrive faster than refined supply can be secured, inventory does not gradually decline. It vanishes. And once lead times stretch into weeks, there is no lever left to pull. This is why suspensions happen suddenly, not because conditions changed overnight, but because the last margin of flexibility was quietly consumed. What looked stable from the outside was already hollowed out from within. The moment sales are halted is simply the moment that reality becomes undeniable. This imbalance is not isolated to one institution. The same refiners serve multiple mints. The same bottlenecks apply everywhere. When one buyer absorbs more capacity, another is left short. Stress transfers through the system whether participants acknowledge it or not. And this is where conventional thinking fails. People assume high prices will summon supply. That works in markets with idle capacity. It does not work when production is fixed, lead times are long, and competition for inputs is global. In those conditions, price does not create metal. It only reallocates it to the highest bidder. This is why the situation feels unstable. Because it is. The system was never designed to synchronize demand across multiple channels. It was designed to function on confidence and rotation. Once rotation stops, pressure has nowhere to go. This is the point where skeptics usually step in. They argue that what you are seeing is nothing more than temporary fear, that buyers are overreacting, that demand will fade once emotions settle and everything will return to normal. On the surface, it sounds reasonable. After all, markets have seen panics before. Shelves empty, headlines scream, and then supply chains adjust. The problem is that silver does not behave like consumer goods. Silver is not produced on demand. It is a byproduct of complex mining operations that take years to expand. Refining capacity does not sit idle waiting for a surge. It runs near maximum utilization because margins are thin and capital is expensive. When demand spikes, There is no switch to flip. There is only a queue. This is where the comparison to short-lived shortages breaks down completely. Those events are cyclical. This one is structural. The imbalance between physical demand and available supply did not appear overnight. It has been building quietly for years, driven by industrial consumption, energy transition technologies, and the steady erosion of trust in fiat systems. Panic buying may accelerate the process, but it does not create the problem. It only exposes it. If this were purely emotional demand, institutions with deep relationships and financial backing would absorb the shock. They would pay up, secure material, and keep operating. The fact that they are stepping aside instead tells you that the price required to maintain flow has moved beyond what the system can tolerate. And that distinction matters because emotional demand fades. Structural constraints persist. Once inventories are depleted and lead times extend, the system cannot reset quickly. Even if buyers pause, confidence does not instantly return. The memory of scarcity lingers and behavior changes with it. This is why dismissing what you are seeing as fear-driven is dangerous. It encourages waiting. And waiting in a supply-constrained environment is often the most expensive decision you can make. There is another layer most people miss entirely, and it sits far beyond retail behavior. Physical silver is not just an investment asset. It is a critical industrial input. When supply tightens, manufacturers do not speculate, they secure. And when they secure, they do so with urgency and scale that dwarfs retail demand. Industrial users cannot wait for sentiment to improve. Production lines do not pause gracefully. Contracts do not disappear because materials are hard to source. When availability becomes uncertain, procurement teams are forced to lock in inventory regardless of price. That is how stress migrates from the investment side of the market into the real economy. This is where the competition becomes asymmetric. A retail buyer may hesitate over premiums. An industrial buyer cannot. The cost of not having metal is exponentially higher than the cost of paying up for it. When these players enter the same pool of limited supply, price ceases to be a negotiation. It becomes a function of survival. At the same time, geopolitical constraints tighten the noose. Refining capacity is concentrated, and export controls quietly reshape flows long before the public notices. When large refining hubs prioritize domestic needs or strategic reserves, downstream markets feel the impact immediately, even if no announcement is made. Supply does not disappear. It simply stops moving where it used to. This is why shortages feel sudden. The metal did not vanish overnight. It was redirected. And once redirected, it is extremely difficult to reclaim. Markets that depend on just-in-time delivery are the first to feel the shock. This dynamic is what turns supply stress into price instability, not speculation, not narratives, but the collision of fixed production, strategic hoarding, and non-negotiable demand. Once that collision occurs, volatility is no longer optional. It is inevitable. When pressure reaches this level, the market starts sending signals that feel contradictory unless you know how to read them. You may see the quoted price hesitate, stall, or even dip, while physical availability continues to deteriorate. This confuses people. They assume falling prices mean easing conditions. In reality, it often means the opposite. Paper markets react first to leverage, not scarcity. When stress rises, margin requirements change, risk managers intervene, and speculative positions get forced out. That creates selling pressure on screens even as physical demand remains relentless. To the untrained eye, it looks like weakness. To those watching inventory and delivery timelines, it looks like a warning. This divergence is one of the most reliable indicators that something is breaking beneath the surface. When the number everyone sees stops reflecting the experience of those trying to take delivery, trust erodes fast. The market splits into two realities, one tradable, one tangible. This is where decision-making becomes critical. Chasing price movements without understanding the structure behind them is how people get shaken out at the worst possible moment. Volatility is not random here. It is the system attempting to relieve pressure where it can, because it cannot relieve it where it matters. As this split widens, behavior changes again. Some participants step back convinced the signal is false. Others lean in understanding that access is becoming more valuable than timing. History favors the second group, but only if they act before the window narrows completely. This phase does not last long. Either confidence is restored through supply relief or the divergence forces a reset, and resets in physical markets are rarely gentle. Once divergence is visible, the market enters its most deceptive phase. This is where hesitation feels rational and action feels risky. Prices on a screen may flicker lower. Commentators begin talking about cooling momentum, and doubt creeps in just as access becomes hardest. This is the moment that separates preparation from reaction. What matters now is not prediction, but conditional thinking. You do not need certainty. You need triggers, clear signals that tell you when conditions have crossed from unstable to irreversible. Availability delivery timelines and replacement cost matter far more than daily price movement. When those metrics deteriorate together, the system is no longer self-correcting. At this stage, behavior becomes binary. Institutions protect inventory. Dealers ration supply. Buyers who hesitated begin competing with those who acted early. The emotional tone shifts from analysis to urgency even as public narratives lag behind. By the time explanations catch up, positioning is already decided. This is also where mistakes are amplified. Acting without a plan leads to overpaying. Waiting without a plan leads to exclusion. The only advantage comes from clarity, knowing in advance what conditions justify action and what conditions justify patience. This is not about timing a top or bottom. It is about recognizing when flexibility is gone. Once flexibility disappears, the market does not reward finesse. It rewards presence. By now, the pattern should be clear. This is not a story about price. It is a story about access, confidence, and control. Every phase we have walked through leads to the same conclusion. Systems built on assumption function smoothly only as long as those assumptions remain unchallenged. Once they are, behavior shifts faster than explanations ever can. This is where mainstream interpretation consistently fails. Coverage waits for confirmation. Analysts wait for statements. Investors wait for consensus. But physical markets do not wait. They respond to constraints, not commentary. By the time narrative is adjusted, positioning has already happened. The most common psychological trap at this stage is the belief that waiting preserves optionality. In reality, waiting often eliminates it, as availability contracts choices narrow. What felt like patience quietly becomes exclusion. And when access finally returns, it does so at a higher cost and under tighter conditions. This does not mean reckless action is justified. It means indecision carries its own risk. The advantage belongs to those who understand structure well enough to act before the window closes, but not so early that they exhaust flexibility. What makes this moment uniquely dangerous is that it still feels dismissible. There is no single headline declaring a crisis, no unified acknowledgement. That ambiguity is exactly what allows the shift to complete before most people notice. This is how transitions actually happen, not with alarms, but with silence. Now we arrive at the part most people skip and the part that matters most. Strategy, not prediction, not fear, not hype, but discipline. Because once you understand how this type of stress propagates, the goal is no longer to guess what happens next. The goal is to make decisions that remain sound across multiple outcomes. In every plausible scenario from here, one truth holds. Markets that lose flexibility do not reward hesitation. They reward preparation. Whether conditions resolve through a sharp repricing, a prolonged period of elevated premiums, or a volatile reset between paper and physical, the common denominator is that access becomes more valuable than timing. The lesson is not to chase. It is to define your thresholds in advance. Decide what conditions justify action, what conditions justify patience, and what signals invalidate your thesis. That clarity removes emotion from the process. It turns chaos into structure. Another lesson is humility. No one controls this system, not policymakers, not institutions, not commentators. When supply constraints intersect with strategic demand outcomes emerge, they are not engineered. Respecting that reality keeps you adaptable instead of rigid. Finally, remember why early awareness matters. Not to feel superior, not to panic, but to act deliberately while options still exist. Most people will only engage when certainty feels comfortable. By then, comfort has already been priced out. If this analysis helped you think more clearly about what is unfolding, subscribe to the channel so you stay ahead of the next signal. Share this with someone who still believes price alone tells the full story. And leave a comment letting me know how you are approaching this environment, because informed discussion sharpens everyone's edge. The window does not close all at once. It narrows quietly. Those who move with intention notice the difference.